Hello, and welcome to this episode of The Financial Translator, where we discuss financial topics in layman's terms to move you from confusion to confidence on a given topic. I am your host, Kirk Kreckmeyer, the Principal Advisor at Pebble Valley Wealth Management. We are a fee-only financial advisory firm helping our clients make informed decisions on their road toward financial security. You can find more information at pvwealthmgt.com. On today's show, we're going to provide a 2025 year-end tax planning update. You can also find this information on our blog post, which we have some tax tables there and some helpful links to previous blog posts to expand upon the topic. Today, I'm joined by Allie, helping me along with these tax planning discussions.
Yeah, happy to be here.
Excellent. Well, welcome to the video podcast. So
thank you.
These mid-month podcasts are going to be a conversation, so either Allie and myself or Bree and myself, and maybe even an outside guest every once in a while. So make it a bit more engaging for us. Before we begin, as a brief legal disclaimer, our discussions here should not be construed as financial or investment advice, and in particular today, tax advice, and each person's situation is unique. All right, let's go. So nothing says let's have some fun like tax planning, right?
Yeah.
And a lot of people like to just push this off until next spring. It's like, well, Kirk and Allie, why bother? It's year end. I got stuff going on.
Season, on top of people's minds.
Maybe it may have some missed opportunities. And so I think if they don't consider some of these things, they miss out.
For sure. It's worth looking at. And, I think it's confusing too, because some things, are due in the spring, some things are due by year end. So, one of the things we want to talk about today are kind of, breaking that out for people, what they need to think about now versus, what can be done in the spring.
Yeah. So there are some year-end deadlines they have to think about then.
Yeah, for sure. So, let's go through maybe first off what needs to be done by year end. Anybody that is contributing to their, 401k or 403b plan, that, employee contributions need to be done by year end. It's always kind of good to check, now, if not earlier, just to see kind of where you are, whether you're looking to get that employer match, which, we recommend for everybody because that's free money, or, trying to max out. If you go in there and see that you're falling short, you can kind of crank up that contribution amount, and hopefully hit it with your last paycheck or two.
And then remember to turn it off in January.
Yeah, exactly. Notice that when your paycheck is a lot lower. Another thing too, if you've already, you go in there and you've noticed you've already maxed out, and you still have some savings capacity. I think a lot of people don't know that they may, it's plan specific, have that after-tax contribution option, which is, another, great thing if you're looking to get some money, say you're, not eligible to contribute to a Roth because of income limits, you can put some in that after-tax contribution bucket and then convert it over to your Roth account.
Mm-hmm. Yeah, it was nice with the 401ks and 403bs. None of the income limits applies, which is a very nice feature.
Exactly. Another account type that, a lot of people have are 529 accounts. Mm-hmm. This kind of applies to not only contributions, but also distributions. So if you have a 529 account, you want to make sure you get your contributions done by 12/31. Also, if you're looking to take distributions to, pay for expenses, those need to be done by year end to count for any expenses that, were made or need to be done by 12/31. Mm-hmm. So, always worth, reimbursing yourself by the end of the year for those. For, clients that are charitably inclined, another account type people may have are donor advised funds. Those are always, something that can have a big impact, especially if you're in a higher bracket and you typically make a lot of donations to charities. Sometimes, what we do is we have clients, what we call, bunching, where they'll make a large contribution to a DAF. So they get a, large deduction. So kind of really, get the most bang for their buck in terms of getting that, deduction for charity. Mm-hmm. So, if you find yourself in that situation, contributing to a DAF, opening and then contributing to a DAF is something that, is worth looking into.
Yeah. And you had a kick there too. I think either cash or even like appreciated securities.
Yeah, exactly. So if you
trick,
large gains on a stock, you can always, use that instead of cash. Mm-hmm. Another account type that has a deadline is a FSA, which is a flexible spending account. Mm. Very different than an HSA. So I think a lot of times people get confused, or may think they're the same, but just to be clear, they're very different.
Right.
Flexible spending account is, you can either have one for medical expenses or also the dependent care. So if you're contributing to those, those are use it or lose it. So you want to make sure that, you whatever you contributed to those accounts, you take out by year end.
Mm-hmm.
Let's see. Am I missing any others?
I don't think so.
that
With the FSAs, you mentioned, because it's good you emphasize that it's use it or lose it. So definitely
Right.
want to make sure you use it. And so, I guess like the dependent care, I think you use those, right? So
Yeah, we do.
what is you just submit expense and they reimburse you, just draw it out the account?
Yeah, they're
throughout the year
really
as you
easy. I
need it?
think some
Okay.
people are intimidated by them, but it's easy. So, especially if you have kids in daycare, or even, camps, after school programs, if you're going to incur expenses throughout the year for childcare or related costs, contribute to the account. Usually what you do is then submit expenses to your employer,
Mhm.
and then they reimburse you
okay.
for the amount of the expenses. Yeah. So
I imagine actual expenses are a bit higher than what they allow you to put in. So, yeah, that's a good one to use. So
yeah, for sure.
And like you said, it's different than the HSAs, the health savings account.
Exactly.
Yeah.
Yeah. So those, whatever you contribute, you don't need to necessarily take it. You don't lose it like you
Right,
would
right,
with
yeah,
FSA.
yeah, okay.
And in fact, if you don't use it, you can let it grow, which is a whole nother, topic for another day.
Right.
But yeah, so those would be probably it for accounts that, have deadlines by year end.
Yep.
I guess accounts that can, wait till the springtime are, one of those is the HSA, like we just talked about. So if you are contributing to an HSA or using an HSA plan, those contributions can be made all the way to tax time, the tax deadline. Another one is your IRAs, whether it's a traditional IRA or a Roth IRA. Some people like to wait until the spring because they don't know, because of income limits, which one they can contribute to.
Yep.
Other times people, may want to wait till bonuses kick in, so they have that extra cash to make the contribution. So, some people may do them earlier in the year, but if you aren't quite sure, whether the deduction will help you, whether you will, fall within the income limit, or, just need the cash, you can wait for those until the springtime, which is nice.
That's probably one of those common things where people think they can wait until next spring, is because most people are contributing like to the IRAs or HSAs, and that's true, they can wait, but these other things you mentioned earlier, that's why it's good that they look at those as well. So
and then I guess related to IRAs, one thing we didn't mention in terms of like year-end deadlines are RMDs.
RMDs, yes.
Which is, a big deal.
Yeah, and the R stands for required.
Exactly.
So a key thing to pay attention to them. So yeah, definitely the RMDs, required minimum distributions. But the main thing is, the tax advantage accounts, obviously you can defer taxes as you put money in, but eventually the government says, well, I need my taxes. So,
right.
So that's the required. So the concept is, if you have I'm going to break it apart into if it's your own account or if it's an inherited account. So if it's your own account, and if it's a Roth IRA, no RMDs. That's the beauty of Roth IRAs. That's another whole topic for another time. But so there are no required distributions on your own Roth IRA, or when I say IRAs, it's IRAs, 401ks, 403bs. I'll give you one exception later, but so it's all lumped together. So distributions for Roth, it's yours, not required. That's the beauty of them. If it's your own traditional IRA, and you reach age 73 before the end of the year, then you have to start taking the money out. Some people maybe think, well, Kirk, I thought it was 70 and a half or 72. They bumped it up. I think it was a Secure Act bumped it up recently.
Yeah.
So 73 is a magic year. And you follow a table. There's publication 590 A or B, I forget which one, but find the table, your age, and then you consider or calculate what you have to withdraw. So one other quick tidbit there, some people, if you want to, you can, the first year, you can wait till the next year to take your required distribution. Right. It's only April 1st, not April 15th. But the problem is the second year RMD, you have to take out as well that year. So stacks up income 2 years. So
right, exactly.
I forgot to mention that withdrawals from IRAs do count as ordinary income. So when people look at those tax tables, it's the higher tax rates is what this applies to. unless you had non-deductible contributions earlier, but let's just table that for later.
You know what, you mentioned 70 and a half.
Mm-hmm.
And I know, again, with RMDs, again, the number kind of changes, every few years or whatever.
Yeah.
And now it's 73, but 70 and a half still applies to something.
That's right. Yeah, the QCD, so the
Right.
qualified charitable distributions.
Exactly,
Yeah.
which, need to be done before you do your RMDs.
Correct. Yeah, that's a good point. So
Yeah.
with year-end deadlines, these required distributions, if your person is charitably inclined, you are able to do this. This is called a qualified charitable distribution, QCDs. Has to come from your IRA and has to go directly to the charity.
Right.
A couple of rules there, though. One, like you just mentioned, if you're going to do that, do those first before you take out your required amount, because then you've lost that benefit. And the benefit is if you use a QCD, let's say you have to take out $20,000 for the year for the RMD. If you want to give $2,000 to a charity, you can do that first, and then you only have to do $18,000 for the required.
Which lowers your income for the year, which is great.
Yeah. So again, you have to be at least age 70 and a half or older. So you can't do this when you're under that age. But yes, if you are, and even if you're 70 and a half and you want to do it, you still can to save on taxes. But yeah, that's a good point on the RMDs. If you're going to do the QCDs, do those first.
Yeah. And I don't think people too, they're like, oh, it's 70 and a half. Like, does that half really, can I make it when I just turned 70? No, I'm going to be 70 and a half later, that year. No, you have to wait. Right. So that's kind of a quirky rule with those.
Yeah. So that's a good point on those. And then jumping to the same concept like these QCDs that I discussed, you can also do that for an inherited IRA. Again, the same rules, have to do it before you take out R&Ds, 70 and a half, et cetera, et cetera. But with the inherited IRAs, there's a couple of nuanced rules with inherited IRAs. So, and in fact, I have on my blog post, I have a table because I always get confused myself. So again, distributions required for inherited IRAs, they break it. There's a couple of distinctions. So the first distinction is the IRA you inherited, did that person pass away before 2020 or after? If they passed away before 2020, then follow the old rules. There's a table. It's a different table just because they make things confusing. Different table. Apply the calculations and take out your required distributions. And you get to do that. Some people call it a stretch. And so you find your factor, and then it's just a little bit each year. And for as long as if I'm 60 years old now, I might stretch it out for 25, 30 years with the tables if I inherited something from somebody who passed before 2019. Another thing, a lot of people don't realize this. Earlier, I mentioned there is no RMDs for your own Roth IRAs, right?
Right.
If you inherit a Roth IRA, which is now becoming more common because not many people had them, but inherited IRAs, Roth IRAs also need to have required distributions. So make sure that people are aware of that.
Right. And one other change, I think it used to be where you had to take an RMD from Roth 401ks, and that no longer applies.
Correct. Yes. Yeah. So if it was directly on your own,
right? Exactly.
If you inherited, you still have to take those.
Right.
So yeah, that was a good point. I should have mentioned earlier on the Roth IRAs. If it's your own, no distributions, including, like you said, your own 401ks. Yeah. So the passed before 2020. Follow your rules, and you got to stretch it out. Then, if a person passed in 2020 or later, their Secure Act, the gift just keeps on giving, right? Yeah. Secure Act gave us some new rules, and there again, if it's a Roth IRA, so the first key rule is you have to deplete it within 10 years. So the stretch is gone. Mm-hmm. So unlike what I just described before, you've got to deplete it in 10 years. The next rule they say is, okay, was that person that passed away taking their own RMDs when they passed? And then if they did, there's different rules. So the first thing is, if it was a Roth IRA, there are no RMDs for that individual, so that you can wait until the 10th year and take it out. You can take it out before if you want, but with a Roth IRA, the nice thing is it's not considered taxable income. With a traditional IRA, was the person taking an RMD, like were they themselves, like using this year's example, age 73, if they were younger when they passed, unfortunately, then it's like, no, they weren't taking RMDs, and so you too don't have to take anything out in years 1 through 9, but you have to do it in no later than year 10. I'll get into that in a second of why you might want to do it earlier. And then finally, the third confusing piece is passed away in 2020 or later. The person was taking an RMD. There, you do have to take RMDs even before year 10. Now, some of the viewers may be thinking, well, Kirk, no, the IRS waived those. I've been waived for a while.
It's confusing.
Very confusing. In fact, when I read the rules, it's like, well, no, I don't have to do it. And then some people said you do. Because of the confusion, the IRS says no RMDs are required in 20. Each year they came out. 20, no. 21, yeah. So this year, 2025, they finally said, you've got to do it. We're going to clarify the rules. You've got to do it. So I won't get into the details now. Look at it. But if you have a inherited IRA, the person passed away in 2020 or later, and that person was taking RMDs, you have to take out money starting this year and still get it done by the 10th year.
Yeah.
I mentioned the 10th year. These are required distributions. Again, you can always take out money whenever you want. With an inherited IRA, there's no early withdrawal penalty. So it's your money. If it's a Roth, it's not taxable. If it's a traditional, it will be taxable. So a person has this concept of waiting until year 10 if they want. But if it's a pretty big IRA, again, that's ordinary income coming on your tax return.
Right.
So you may want to oh boy, over the next 10 years, I have to recognize all of this, look at your own tax return and maybe spread it out, maybe even above and beyond the RMDs because you want to spread out the tax hit.
Right. Because so another kind of strategy we were going to talk about is Roth conversions. And kind of when we're looking at those, we're kind of projecting people's, future tax brackets, also looking at when they're taking Social Security. So kind of same thing. If you're, have these inherited IRAs and you, are going to have to be taking RMDs, you may want to be looking at those things too. Like, okay, well, if I wait, but then I start having to take Social Security, that's just more income that might kick you into some, higher brackets than you were anticipating.
For sure.
So,
that's again with the stretch, it wasn't as big of a deal because it was much smaller amounts. But,
right.
But the Roth conversion, that's definitely, speaking of year-end tax planning strategies, that's definitely worth. Let's talk about those, right?
I'm very busy with this.
So now,
yeah, no, and it's definitely a valuable strategy that I don't think a lot of people think about. A lot of times, when people are retired, you maybe were used to being in a higher tax bracket because you were working, you had all this income. All of a sudden, you're retired. You aren't required yet to be taking these RMDs that you were talking about. So you find yourself in these lower tax brackets, which is kind of nice. And so, a lot of times when we talk with clients and we're like, well, actually, let's start taking some money out of your IRAs and realizing income and maybe even kick you into a higher bracket, than you would be normally. Right. They kind of look at us like we're crazy. But, over the long term, it can really have a big impact on your future tax brackets. If you can kind of start, whittling those IRA accounts down before you're forced to take out these, possibly large RMDs.
Yeah, when I talk about the concept too, it's like, okay, you're in the 12% bracket. You're going to be in the 22 or 24 later. Let's use up the 12. It's
right.
The tax arbitrage. And oftentimes, when you talk to a person, it's like, hey, I really want you to pay taxes before it's required.
Right.
They're going to kick you out of the right? Yeah, but I really trying to explain the concept. In fact, I was just talking to somebody, not a client, but I get some talks at the local library. And when I was explaining the concept, he came up to me afterward and said, man, he's, I think, like 68 now. So he's been retired for about 5 years and he wasn't doing this. And so
it's kind of a short window sometimes. Yeah.
Short window. And once the calendar year, that's why we're having this discussion of year-end tax planning. Once the calendar year flips, that opportunity is now gone. And so he missed out on those 4 or 5 years of pulling some money out in that 12. And he's going to be stuck in pulling out at 22. So
right. So, and I kind of like on another end of the spectrum, so we just talked about people maybe that have just retired. Also people that, may be finding themselves in a single tax bracket, like older people, or even somebody that is, in a single bracket, like your grandmother and, her tax rate is lower than maybe the people that would be inheriting this money from her. Sometimes it's worth having them, again, recognize more income, pull out more money from those IRAs at those lower brackets,
right, for sure,
before they have to pass it on to their children who may be again working in these higher brackets, but now being forced to take these RMDs because they are subject to those 10-year rule.
Right, for sure. So like multi-generational tax planning. So
exactly,
definitely it's worthwhile having those discussions and asking
Yeah.
asking. There again, you may get resistance of, hell no, I'm not going to pay taxes early. That's my kids' problems, and that's fine, but make them
Right.
aware.
Yeah, exactly.
Yeah, so that's a good point.
Yeah, but when we're looking at those, some things that kind of sometimes cause some complications
Yeah.
are like the IRMA bans.
Yep.
So that sometimes we run into the situation where it sounds like a great idea, but then we recognize, if you recognize more than you need to or want to, it can kick you into a higher ban for Medicare.
Yeah, so definitely
premiums.
Talking taxes is fun, but it's also gets complicated, and especially this is definitely one where, again, I mentioned the 12 and the 22 that you talked about with the tax arbitrage. That's one consideration, but these IRMA, so I don't care what it stands for, but it's Medicare premiums, and so
Right.
A person pays, I think it's going to be like $200, it's over $200 in 2026. So everybody pays that. But then if you have income above certain levels, they make you pay more. So when you hear the word IRMA, that's like this extra Medicare premium that you have to pay. Well, if you do a Roth conversion, that adds to this income trigger.
Exactly.
And so you want to watch that. There again, sometimes it makes sense to go in to the first band.
Right. We've done that for some clients.
Yeah, for sure. Again, they're like, well, not only you make me pay taxes early, you're making me pay more Medicare. But again, multi-year planning, it sometimes can make sense. And then this year too, so one thing I haven't mentioned yet, and again, on my blog post, I have a link to, I gave a summary in July, the Congress and the president signed into the One Big Beautiful Bill Act. So OBA is a short term. I've got a blog post with a link on my, I think it was in July, I put it out there. But anyway, there are some considerations that take into effect in 2025, and there are some extra deductions that you get, extra SALT. I won't get into the details, but many of them have income limits, or they start to go away. So there again, when you're doing this tax plan we're talking about, it's important to be aware of, okay, what's your tax bracket? What's IRMA? What are these new deductions? Make sure you don't trip yourself in, or if you do, make sure you do it consciously. With eyes wide open going in, that it makes sense. And so it gets complicated in a hurry, but
yeah, for sure.
Yeah, that's why it's keeping us busy at the end of the year here, right?
Yes, indeed.
Yeah, so so it's a fun, just some of the many considerations for.
Yeah, and kind of one last thing we haven't talked about is tax loss harvesting. And yes. I know it's something that we are looking at kind of throughout the year. Mm-hmm. There's, even automated tax loss harvesting strategies people can be in, which we have for some of our clients, mm-hmm. That again are, doing this throughout the year, but it's always worth kind of, glancing one more time, before year end, especially if you have a taxable account with mutual funds, since those kick out those distributions, mm-hmm. Just to see if there's, any opportunities in terms of harvesting losses to offset some gains before year end, because again, that's another 12/31 deadline.
Right, for sure, yeah. And again, if there are some losses, it'll lower your income, which helps all those other factors.
Exactly.
And those losses too, again, on the blog post, if they're long-term, meaning you held them for 1 year or longer, I guess for the losses, never mind. I was thinking of gains, but so just be aware of the short versus long and how you treat them. The other thing too, you mentioned losses for sure. It's worth looking at. But another nuance that not people realize, if you're in the 12% or lower, closely, it's off a little bit, but 12% or lower tax bracket, the capital gains tax rate is 0. This is all at the federal level. So all these taxes we're talking about is federal taxes, with the exception of the 529s. So sometimes tax loss harvesting, you mentioned, but sometimes you might want to do tax gain harvesting.
Right.
If you're in that 0% bracket. There again, warning, OBA, all these different rules.
Right.
So watch out for what it's going to do to taxable income, all that stuff. But so it's definitely a good opportunity. People maybe if they're younger, they're not in the worrying about Social Security or Roth conversions right now. But if they're in a bracket and they have an opportunity, they can potentially realize some gains as well. So
right.
Well, that was there's more to talk about, but I think we better stop there. It's been how long have we been? You've been about 25 minutes, so people are going to go people out here. So yeah, so
people want to listen to in terms of tax strategies.
Like I said, it's an important topic, and hopefully this was helpful. I mean, if nothing else, you made you realize that there are some year-end tax planning opportunities. It can be fun, especially if you're saving money. What's not fun about that? So make sure you go out, figure it out, and grab your piece of the tax savings. and then grab a piece of your pumpkin pie. Everyone have a happy Thanksgiving. All right, that's a wrap on today's topic. Thanks a lot.
Thanks, everybody.
Thank you for listening to this episode of The Financial Translator. I hope this discussion helped clear up any confusion and will lead to more confident financial decisions. Thanks for your time, and be sure to check out all of our resources at pvwealthmgt.com. Until next time, go confidently.